In 1929, America thought it had broken the business cycle. Stocks rose for years. Economists spoke of a new era, where crises were a thing of the past. Then within months, his fortunes went up in smoke. A decade of misery followed. In 2008, people believed that housing was a one-way bet. Home prices never fall across the country, they said. Bankers agreed. So did regulators. The global financial system was built on that saying. Then a few mortgages went bad, and the whole structure collapsed. It's 2005. And here's the uncomfortable truth. The elements that existed before 1929 and before 2008 have all reappeared. Not even vaguely similar. Almost like a copy. Soaring asset prices, massive debt, massive leverage, a culture that believes the central bank will always step in before things get bad. This film is not intended to predict the exact date of the accident. It's about recognizing a pattern that has played out twice and seeing that we're on the same path again. This is not fortune-telling. This is pattern recognition. 1. The accident has not happened yet. Every major accident starts the same way. Not out of fear, but out of confidence. Right now, the market price is as if gravity has been turned off forever. Stock indexes are near or at record highs. Luxury real estate in major cities is selling at prices that previous generations would have considered crazy. Governments, companies, and households all owe more money relative to income than at almost any time in modern history. However, the mood remained calm on the surface. On one side are ordinary people struggling to pay rent, car payments, and credit card balances, hoping that their retirement accounts will be enough. On the other hand, institutions borrow billions of dollars with just a few clicks, believing that if anything goes wrong, the central bank will sort it out. For the past 15 years, they have been right. Since the 2008 crisis, the message has been clear. If the market falls, the Fed will cut interest rates. If that's not enough, it prints money. If that's not enough, the government will send checks directly to households and businesses. We have built an economy on the assumption that there will always be someone somewhere who will pull the emergency brake before the train hits the wall. But here's the thing. Every time you use the emergency brake, the brake wears out. By 2025, interest rates had fallen to zero and then soared again. Central bank balance sheets had ballooned into the trillions. Governments were drowning in debt. The tools that saved the system in 2008 and in the pandemic of 2020 have been used hard. The question is very simple. What happens when the same collapse happens again? But the arsenal to fight it is nearly empty. 2. Everything bubble. To understand why the next recession could be worse, you have to consider the scale of the situation. Every previous crisis has had a center. 1929 is stock, 2008 was housing and mortgage debt. This time, things were different in the worst way. The bubble wasn't confined to one corner. It had permeated almost everything share. Valuations in many markets assume perfect perpetual earnings growth. Price-to-earnings ratios, simply put, how many dollars you have to pay for a dollar of earnings, are well above historical norms. That doesn't guarantee a crash, but it does mean there's little chance of disappointment. Housing. In many cities, median home prices are 5, 6, or even 7 times the median household income. Traditionally, a ratio of about 3 to 1 has been considered healthy. Above that, housing ceases to be a refuge and becomes a speculative asset. Corporate debt. Companies borrowed heavily when interest rates were near zero. They refinanced old debt, bought back their own stock, and acquired competitors. Capital accumulation was cheap. That cheap money is now flowing into a much more expensive world. Government debt. The total national tax bill is in the tens of trillions. To put that in perspective, if you paid $1 million a day, it would take tens of thousands of years to pay back $1 trillion. Multiply that by tens of years, and you're still not even close to the actual figure. Household debt and consumer debt. Credit cards, student loans, car loans. Many households are already strapped for cash. One job loss, one illness, one interest rate hike. And the math becomes meaningless. Add it all together, and you get what some analysts call everything is a bubble. A situation where most major asset classes are inflated at the same time, and almost every major company is running on credit. The belief system that supports this structure is simple. If something goes wrong, the central bank will fix it. For a decade after 2008, this seemed to be true. Interest rates were cut and stayed low. When rate cuts weren't enough, central banks invented a new tool, quantitative easing. Quantitative easing, or QE, is a technical term for something very simple. Central banks create digital money and use it to buy financial assets, usually government bonds. This pushes up asset prices and pushes down long-term interest rates. It worked, at least in the short term. Asset prices rose, borrowing costs fell, owners of stocks and real estate saw their wealth soar. But there is one thing worth noting. When you solve every problem by cutting interest rates and printing money, you are training investors like guinea pigs. Every time they press the buy the dip button, the reward appears. Over time, the fear will disappear. This is called moral hazard, when people take more risks because they believe others will suffer if things go wrong. Now, back to the present. Interest rates have been pushed too high to combat the inflation that money printing has helped create. Central bank balance sheets have become enormous. Governments have accumulated more debt than ever before in peacetime. Fire extinguishers were sprayed on all the flames. The faucet is still in hand, but the tank is empty. We are sitting on the biggest pile of wood in history. Stocks, houses, debt of all kinds, with the fire brigade having used up most of the water. You don't need to know exactly what second the match will fall to know the risk is real. 3. Why does the pattern look familiar? There's a rhythm in the big bubbles. Details change, but sentiments do not. In late 1920s, stock prices have been rising for years. Borrowing money to buy stocks has become the norm. People buy stocks with money they don't have, using margin, a loan from their broker. As long as prices rise, they feel like they're getting free money. Newspaper headlines proclaimed a future where recessions were obsolete. Barbers and taxi drivers traded advice on which stocks to buy. The phrase perpetual prosperity appeared in speeches and newspapers. We know how that story ends. A small wavering turned into a stampede. In just a few years, the stock price lost much of its value. In early 2000s, housing played a central role. Banks lent money to virtually anyone. Complex mortgages, wrapped in even more complex securities, spread throughout the global financial system. The idea that house prices never fell across the country became a comforting mantra. Once again, leverage quietly built up. Families struggled to buy homes they could barely afford. Banks bought mortgage bonds they didn't understand. Credit rating agencies approved it all. Some payments are late in remote areas, has become a global financial heart attack. Nowadays, we don't have a clear villain. We have something broader, belief in intervention. Sure, everything is expensive. Sure, there is debt. But this time, we have tools. Central banks understand the system. They won't let it fall. In 1929, the illusion was that the market had become naturally stable. In 2008, there was an illusion that housing was unbreakable. In the mid-2020s, there was an illusion that policymakers could always prevent a real crisis. Different stories, similar function, convince people that the risk has been contained. And in every previous episode, it only took a small spark to reveal how fragile the structure really is. 4. 3 ways a fire can start. The dangerous part of this moment is simple. We don't need to guess the exact cause. We just need to understand that this system is so stressful. Almost anything can be this system. However, some fault lines are more obvious than others. Commercial real estate, silent sinkhole before 2020. Large office buildings were considered safe, boring investments. Tenants signed long-term leases. Workers filled the floors. Rent was paid on time. Banks happily financed them with low-interest loans. Then the world changed. Remote work has turned entire malls into ghost towns just a few days a week. Companies that once needed 5 floors have found they can operate on just 2. Occupancy rate decreased, but the debt remains the same. Many of these buildings were financed when the cost of borrowing was extremely low. Imagine a landlord paying 3% interest. At that rate, the tenant's rent would cover the monthly payments. Now imagine that loan is about to expire. The building has to be refinanced at double the interest rate or more, and with fewer tenants. At 7 or 8%, the calculation reverses. What was once a stable asset is now a money pit. Rational owners will look at the numbers and make an informed decision. Go. They handed the keys to the bank, instead of continuing to withdraw cash. Who is to blame? Most of regional and community banks, smaller institutions, hold the majority of commercial real estate loans. If defaults on office buildings and shopping malls pile up, these banks will suffer losses that will erode their capital, which is the cushion that protects depositors. If that buffer shrinks too much, regulators will intervene. Banks closed or were forced into emergency sales. Customers panicked. They moved their deposits elsewhere. Panic spread. We have seen this in a number of bank failures in recent years, blamed on poor interest rate management. But interest costs and real estate values are linked. If a deep wave of commercial real estate pain hits between 2025 and 2027, it could easily be the spark that ignites a broader fire. Cause 2. Business government bankruptcy. Trigger 3. Geopolitical shock. The 5 stages of collapse. Who gets crushed? Who wins? Why 2026, 2027 could be worse than 1929 and 2008. Hidden agents. 3 detonators burning in the dark. Economic collapse rarely comes with a strong boom. They start as tiny cracks, barely audible, easily overlooked, but life-threatening. And between 2025 and 2027, 3 cracks will develop into fault lines. Just one of them is enough to break the system. All 3 combined would spell disaster. Trigger 1. The collapse of the commercial real estate market. The high-rise office buildings that once housed many employees are now just crumbling relics of a bygone era. Working remotely is not a trend. It's migration forever. The buildings are funded at 3% interest rate, must now be refinanced at 7, yes, 8%. Mathematically, they cannot exist. The landlord left, not because they went bankrupt, but because debt is worth more than the building, and the one who suffers is not the homeowner. They are banks, specifically regional banks, the most fragile part of the U.S. financial system. A few defaults, a few bank rebates, a wave of fear, and suddenly the trust is gone. That's how a spark starts a forest fire. 2-second trigger. Corporate debt zombies and government time bombs. For a decade, corporations have borrowed money as if it were an infinite resource. Debt seems harmless, cheap, practically free. But debt is like gravity, it always pulls you down. Companies issuing bonds at 2-3% now have to refinance at 7-10%. Their cash flow can't support it. Their balance sheet is broken. The collapse of a large corporation is never an isolated case. It spread through the credit market like poisonous smoke. Investors dump corporate bonds. Productivity skyrocketed. Freeze borrowing. Healthy companies become sick companies in just a few months. Now let's zoom back out to the sovereignty level. Developing countries owe trillions of dollars in U.S. dollar debt, face rising interest rates and weaker currencies. Just one default by a country like Turkey, Egypt, Pakistan, Argentina could cause mass panic. Banks in the United States and Europe that hold this debt will suffer unexpected losses. Fear spreads faster than truth. One country defaults. Global contagion. 3. The third trigger. A geopolitical shock. Not every financial crisis starts in the financial system. Sometimes the market dies because fear long before the fundamentals are broken. Border conflict, a contested election, a cyber attack, unexpected military escalation. It does not necessarily have to directly harm the economy. It only has to do one thing: make investors skeptical tomorrow. When doubt arises, instinct kicks in. Pre-sale. Ask later. And once millions of people start selling at once, the market will stop working. It becomes a waterfall. 5. Free fall plan. The 5-stage collapse model that never dies. Every major crisis in modern history, 1929, 2008, has followed the same script. The actors change. The costumes change too. But the script remains the same, because this script was not written by the government or the bank. It was written by human psychology, and it takes place in 5 inevitable movements. Stage 1, initial shock. A big company collapsed. A bank went bankrupt. A foreign government defaults. The market dropped 10-15% almost immediately. But instead of panicking, Everyone cheered. This is a buying opportunity. The fundamentals are very solid. The Federal Reserve will intervene. They are confused the first crack to end the danger, not knowing that was just the beginning. Stage 2, false calm. The market is stable, sometimes even rising. This is the most dangerous moment, because hope is back. Commentators claim the worst is over. Analysts give optimistic forecasts. Retail investors buy when prices fall. But beneath the surface, tight credit conditions. Banks get nervous. Corporate recapitalization quietly fails. Liquidity is decreasing. What appears to be calm is actually the silent eye of the storm. Stage 3, the fall of the waterfall. This is where the system fails. Not because people want to sell, but because they right sell. Margin call. The borrower will be automatically liquidated. Fund return. Investors cash out. Funds sell assets at any price. Algorithm. High-frequency trading accelerates decline in just milliseconds. Liquidity collapse. There are no buyers, only sellers. Prices fell sharply. It no longer looks like a market. It's like gravity. Stocks fell 40%, 50%, 60%. Entire industries declined overnight. Companies fail not because they are weak, but because their credit stopped flowing. This stage feels like the system is collapsing, because it is. Stage 4, peak of fear. This stage smells. A cold metallic smell of collective fear. Millions of people lost their jobs. Bankruptcy of the enterprise. Banks shook. People sell anything they can. Still not enough to save yourself. This is where average families look at their savings and wonder, will we get through this? That is the psychological bottom and financial opportunity for a whole generation of cash holders. Phase 5, the long road. Back. When the pain becomes unbearable, the government intervenes. Interest rates drop to zero. Stimulation flooded the system. Struggling organizations will be bailed out. The market stabilized slowly and painfully, but the scars remained for many years. Retirement is delayed. The businesses were gone forever. Houses were lost. Trust is broken. Recovery never happens quickly. It's the slow climbs out of deep holes. 6. Who is beaten until the system collapses. When the financial machine breaks, it doesn't break evenly. This will hurt the most those who cannot defend themselves. Middle-class people who accidentally keep most of their assets in stocks. Home buyers, people who bought homes at peak prices and lost 30–50% of the value of their homes. Small business owner had revenue dry up overnight. Retiree people who depend on fixed savings but suddenly find themselves short. Leveraged traders. People woke up with their accounts wiped clean. Knees bent. Savings disappear. Housing becomes a burden. Debt persists long after the asset is gone. 7. Who is rich during the collapse? Here is the brutal truth. The crash did not wipe out the wealth. They redistribute it. From unprepared to prepared. From fearful person to patient person. From leverage to liquidity. Winners include cashier. They maintain purchasing power and buy important assets at bargain prices. Short sellers. They benefit from the decline of overvalued sectors, like banks, CRE, debt-laden corporations. Holders of scarce assets. Gold and similar assets gain value as fiat currencies weaken. Bad debt investors. They buy the broken bones of bankrupt companies and rebuild destiny from the ruins. Giant private investment firms. They wait with billions in cash, willing to buy businesses, real estate, and assets at a discount of 30–70%. For them, every crash is a shopping season. Every panic attack is an opportunity. 3. Exposed. Why 2026 to 2027 may be worse than any previous collapse accidents have happened before. The debt cycle has broken many countries. Stress has disrupted the financial system. But what's coming is not just another recession. This is the first collapse in history where each pillar of the modern world, debt, energy, demographics, geopolitics, supply chains, and digital finance, also stressful at the same time. Here's why the next crisis is likely to surpass the 1929 crisis, obscured 2008, and redefine the next decade of global living standards. Not because the model has changed, but because the world has become too big, too connected, and too fragile for old solutions. 8. Why this time is much more dangerous. One unprecedented scale in 1929, the U.S. stock market was the size of a regional economy. In 2008, its size was equivalent to the national economy. Today, it is the size of a global empire. A 60% crash will now wipe out $30 trillion, more wealth than the GDP of China, Japan, Germany, India, and the UK combined. When something this big breaks, shockwaves spread across the ocean. Two levers are everywhere. In previous eras, leverage was hidden within a single area. 1929 margin debt, 2008 mortgage. Today, consumers benefit leveraged corporations. The government is leveraged, central banks are leveraged, banks and shadow lenders are leveraged. There is no single point of failure. The entire system is the point of failure. 3. The hyper-connected world. In 1929, the news was transmitted by newspaper. In 2008, via cable television network. Today, it spreads at the speed of market-scanning algorithms in microseconds. When a country trembles, the entire grid vibrates. A glitch in Tokyo could freeze liquidity in New York. The Paris bond panic could trigger a default in Sao Paulo. The next crash won't be like a domino roll. How would it feel? The floor collapsed under each domino at the same time. 4. The government has no more ammunition. In 2008, central banks had the tools to high interest rates they can cut, small balance sheets that they can expand, governments that have the financial capacity to borrow. Today, those buffer zones no longer exist. Interest rates cannot be reduced much. The Fed's balance sheet is huge. Government debt is suffocating. Measures used to avert the most recent crisis, zero interest rates, trillions in stimulus money, huge bailouts, has been deployed. This time, policymakers face the fire with empty tubes. 5. More fragile societies. The economic crisis doesn't just destroy numbers, they destroy trust. The United States today faces increasing inequality, political polarization. The middle class is shrinking, life expectancy is decreasing, erosion of the organization's reputation. Millions of people live paycheck to paycheck. When a financial collapse occurs in an already fragile society, damage multiplied. Economists study numbers, but the ultimate collapse is human events. 9. The timeline is based on symbols. Not prophecy, but mathematics. Patterns cannot predict the date. They predict the sequence. Here's the sequence the world is entering, the same one that defined 1929 and 2008. 2025. Interest in the cracks under the market is high, debt everywhere. The feeling of invincibility, the greatest hope before collapse. Mid-2025, early 2026, first strike, a major banking failure, a corporate collapse, a geopolitical hotspot. The market fell sharply and then recovered. Investors breathed a sigh of relief, but something fundamental has changed. Spring 2026, deceptive calmness. This is the calm before the storm. Stocks rose. Commentators celebrated. Federal Reserve reassures. However, credit markets are tightening. Banks hoard cash. Defaults whisper beneath the surface. The storm is brewing, but the sky is still blue. Summer-fall 2026. The waterfall begins. This is the moment when every potential weakness forced to go public, default will speed up. Lender freeze. Reputation is gone. The market plunged 50–70%. Liquidity evaporates. Sales become mandatory. Feels less like a recession, and it was like gravity had changed direction. Late 2026, mid-2027, maximum panic. This is where the system becomes fragile, as if just one wrong move could break it. Unemployment rate increased dramatically. Banks are reeling. Public confidence lost. Fear spreads faster than information. And in every previous crisis, this precise moment is where the world stabilizes, or snaps. 20s and 27, 2030, a long and painful regeneration process. The problem is over, but the recovery remains slow. Stimulation flooded the system, prices are down, confidence gradually returned. However, the market often takes years to regain their former heights. Financial wounds will heal, but the psychological scars remain. 10. Who suffers the most and why those most affected? Middle-class family retirement accounts cut in half. Savings evaporated. The university tuition fund disappeared. Recent homeowners buying a home at peak prices will turn the home into a burden. Small businesses. When spending dries up, revenue immediately drops. Retired people, fixed incomes are being squeezed by rising prices. Leverage users, margin trader, house flipper investors are heavily indebted. As prices fell, their losses multiplied. In a crash, debt acts like a guillotine. 11. Who survives and who thrives? Every collapse transfers wealth. It doesn't go away, it moves. Profitable people generally have three characteristics in common. 1. They maintain liquidity. Cash and safe assets increase in value when everything else is on fire. 2. They hedge or short weak stocks. Some industries always get disrupted first. History will reward those who see them early. 3. They buy when blood is spilled in the streets. This is where generational wealth is created. Not during boom times, but during the darkest hours of panic. Sounds brutal. The crash did not destroy the wealth. They redistribute it from the unprepared for those who are prepared. 12. The final question and a calm warning. Every empire believes that it is the exception. Moments before history proved it wrong. In 1929, it was believed that the economy had achieved permanent stability. In 2008, it was believed that the risk had been removed from the system. 2025 believes the Fed will always save the day. But history is not kind to systems built on denial. So the question is not, will the accident happen on this day or that day? The real question is, are we living with the assumption that all past failures are common and ignoring it because the truth is too hard to accept? Understanding this pattern is not fear, it is preparation. And preparation makes the difference between being crushed by history and learn to survive.